Welcome back. Those of you, I don't know if you heard Riley's announcement, but those of you, there's about 15 who ordered books from Bookworm so that you don't have to stand in line tomorrow at the Bookworm bookstore. The same books, same price. They give you the shareholder price. We had delivered. One person, I don't know who it is, but they bought $700 worth of books. So I think Bookworm's going to want to do this deal with us again next year. We just tried to make it a convenience for all of you, and rather than have a bookstore here, we just thought we would pass that information along. So our next speaker is an investment professional with over 40 years of experience in finance and investments. Bob Robotti is the founder and president and chief investment officers of Robotti Company Advisors, a highly respected investment advisory firm that he established in 1983. I just want to warn you, particularly those where English is not a first language, that Bob is famous for talking very slowly, being a New Yorker. So I'm teasing. It's going to be the fastest presenter you've ever heard. But I told him that we have a lot of foreign speakers, and if he could slow it down, he's going to try. I'm a walking economy. My hairline is in recession. My stomach is always in inflation. And these two together bring me into a deep depression. Please welcome Bob Robotti.
Hi, everybody. Thank you, Bob. Thanks always for hosting this phenomenal event. Thanks so much for including me. I've been extremely fortunate in life. My first fortune was my degrees are both in accounting. I never took a course in finance, so I never learned that the market was efficient. I didn't get the memo on that. Instead, what happened was I was at the right place at the right time. I walked out in 1975, and I walked into the office of Tweedy Brown, TBK Partners. Included in TBK's lineup of people was Tom Knapp, Walter Schloss, Ed Anderson, people who had worked for Ben Graham. So therefore, they were next door neighbors when Graham decided to go to France to read classics as opposed to invest anymore. These guys walked into Tweedy's office. So that was my introduction to investing. And it was the right time and the right place and the right time. The reason I say it's the right time, 1975 is the beginning of the rocket ship that launched for all value investors. So like the super investors of Graham and Doddsville were all people whose records started around that time. Because that's what it was. You had the 73, 74 stock market correction, that certain stocks that were one decision stocks, you could buy it and hold it forever because valuation was irrelevant, suddenly had problems. So instead, there was a rotation to stocks where valuation matters. And that's the key point we would make. Valuation absolutely matters. And so Tweedy's launching pad and value investing's launching pad came from that point, and a lot happened also in terms of transactions because stocks were extremely cheap that were being ignored in the marketplace, and that's what drove that performance. The reason, of course, I suggest all those things is potentially I'd suggest there's potentially a hard rhyme to where we are today. After that, I got fortunate once again. So Mario Gabelli hired me away to be his CFO and CEO of his nascent firm. Right when I started working for Mario, he managed $7 million. And when I left to start my own firm in 1883, it was $77 million. So it was a tiny firm at the time, but it was great because I got an executive MBA program taught to me one-on-one by Mario Gabelli, and he paid me to attend the class. So that's part of the backdrop of how I've got into this business in my framework. So I think I want to emphasize that I really do think that there's a year or two ago, there's been a huge shift in the economic underlying environment, and people have kind of missed that. And therefore, thinking is critical, especially at an inflection point. And Baruch pointed out, information is not an effective substitute for thinking. And I'll say that again and again. You have to think about it. You can't look at information. You can't necessarily look at patterns, or you have to understand, is that a valid comparison and consideration? More recently, Howard Marks said the same thing, said, technology, information, all these things, the market's efficient. It isn't efficient because underlying it is fear and greed, human emotions that therefore make for opportunities, right? But if you are going to have superior performance, it's probably going to be based on judgments, superior judgments. Superior judgments come from experience. Experience, therefore, enables you to think and make conclusions that may not be demonstrated in recent patterns. So again, I've been doing this for 50 years, so I've seen plenty of cycles, whether that's company cycles, industry cycles, economic cycles, so many different things. And so that gives me a view that the world has cyclicality to it, and things aren't necessarily one-directional. So a couple of years ago, of course, everybody suggested that maybe this is the new norm, right? It's a very interesting period, right? Because clearly interest rates are a key determinant of all valuation, right? And to live through a period of time of 40 years where you saw one part of one cycle, and that is interest rates down only, that is not the normal condition of things. And people a couple of years ago got to presume that that is the new norm. Of course, debt markets clearly are as big as equity markets. I'd suggest to you that I believe all debt markets are mispriced today, or they're priced based on the expectation that inflation recedes to 2 to 2.5%. If it doesn't, then there's a problem with repricing. And that is because there's no real rate of return, right? There's a negative real rate of return in all fixed income today. So therefore, the fixed income market is valued based on the hope that that inflation rate comes down. And we all know that hope is not a strategy for anything. And yet that's what that market of that size is predicated on. And then everything yield related comes from that. So myopia of linear thinking, right? You've gone through such a long extended period of time. People 2 years ago got convinced. You know, I talked to the advisor to the endowment, and I said, gee, should we do anything to protect maybe against inflation? He goes, no, inflation's dead, won't come back, low interest rates forever, that's the environment. And people made huge investment allocations a year or two based on that. And you know, the Twain comment is like phenomenal, I think. And it's not what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And so I think that potentially permeates all investments today, that kind of false belief in something. So not only do you have this extended period of time where interest rates move down, therefore cap rates move up, right? And so therefore everything gets more expensive, more valuable. And so, but instead what you also had was, you know, misdirected Fed policy. I'd suggest that the Fed at the margin does something, but in aggregate is ineffective, right? So what did the Fed do post the financial crisis? It made free money. Why did it make free money? Did it do that to suppress the interest rate, to misallocate capital? I don't think so. It really did it with the intent of, it's the new trickle-down theory. If we make money cheap, that will encourage economic activity. Economic activity will then filter down. And the fact of the matter was, that was a dismal failure, right? The economy was very tepid over the entire decade. So you didn't generate what you wanted. Instead, you had unintended consequences. By leaving interest rates and pressing them down, you know, it was the 2011 annual letter that Buffett said, bonds are a return-free risk. That was in 2011. The fact that the government suppressed rates for all of that time, just think about the misallocation of capital. Value versus growth, right? Value stocks have had not a 7-year, that's not 7 years of feast and 7 years of famine, it's a 14-year feast. The amount of capital that's been allocated based on historical myopic thinking is substantial, and therefore, and not only is that capital invested there, but that capital came from someplace else. Where did it come from? Who's underinvested in capital? What happens when the capital is underinvested in areas? We think that really drives some great opportunities. The idea that the market's cyclical, you know, you just look at history, of course, you know, which of the industries that are in strong positions that do well. I guess there's a phrase that Jim Grant's known as saying is, and that is, in science and in engineering, knowledge is cumulative. In finance, it's cyclical. And that's really important given how long this cycle has gone and what it's done to capital allocation. And not only do you have all these factors driving capital to and away, therefore making valuation risks and valuation opportunities, it also has been compounded by the fact that today more money is managed passively than ever before, That's new. That's a different world that never has existed before. So do you realize that? We're all living in a public equity world that never existed before. And not only is more money passively invested than actively invested, what's supposedly actively invested, we all know, it's an algorithm or it's someone who's following the index, so therefore it's not really actively managed. That's why we also say this period of time, we believe the next decade is going to be the restoration of the stock picker, because you're going to have movement, the winners are going to change, you're going to have dispersion. Therefore, the way to pick whether they're growth companies or whether they're value companies or any of those things, it's selection, because there will be losers and winners, and it's not the group that you can own, and yet all the capital is invested based on buying this group, buying that group, with no individual stock security selection process. Therefore, that's the key differentiator, I think, to the next decade. So where capital is, there's the debt markets, there's the equity markets, and of course there's the private markets. And the private markets, PE, VC, have grown tremendously. I was at a conference last week that a very large advisor held, talk about PE, VC, and they said, gee, you know, it's really relatively new industry. It really didn't exist 40 years ago. And so it's kind of like, well, that's all really interesting too. That's right, the industry didn't exist 40 years ago. And over that 40 years, that kind of coincides with interest rates going from 15% plus down to 0. And what happens when you have PE, private leverage businesses, multiples of the business go up, the leverage helps, and that process is very positive and self-fulfilling. Of course, the problem with the private equity business, we all know, is private equity is marked to model. It's not marked to a market. And so therefore, there is clearly agent risk, because I mark my own scorecard. And to the extent that interest rates have come down and multiples have expanded and I've been levered, if I had a problem at any point, I kind of get pulled out by that macro environment. There's inevitably risk in the entire private equity and VC world, given valuations and given I mark my own scorecard. So here we are, bottom-up stock pickers, right? And of course, recently I realized I'm a bottom-up stock picker who's a value investor. And the fact of the matter is I realized, no, I'm really a growth investor, and I'm really looking at macroeconomics, because clearly, without a doubt, I would suggest, it was 2019, 18, I was interviewed by someone, Wall Street Journal reporter, and he said to me, why do you think that value will actually rotate back? And people have said that for years, and it hasn't happened. So what's the impetus behind that change? And of course, the reality of it is, as a bottom-up stock picker, I'm saying I can't pick the macroeconomic environment, so therefore I don't factor that into my equation. The fact of the matter is, what happens is going to be a huge tailwind or a headwind. And I'd suggest post the financial crisis, the economic environment that existed, extremely low growth, low to no interest rates, consolidation, wasn't an environment where companies that could group together in value, because that's what it is. We may say value and growth, there's no difference. And of course, there's the reality, right? The value of any company is the value is discounted future cash flows. And if those are growing, they're worth more money. So clearly, yes, growth is worth clearly more than no growth or negative growth. But the fact of the matter is, the macroeconomic environment really has a very large influence. And so that's recently for us, we sent away some information to a family office in Canada. And the guy says to us, could you tell me though, what happened to this fund? You know, you've been doing the same thing, but in 2019, you know, before that, you guys were a mediocre fund, and somehow you turned it into a rocket. What happened? And I'm like, well, the fact of the matter is, we've been simming for 10 years against the tide, and the tide was coming in. And that tide came in, and we all know that there are plenty of people when the tide came in and stayed there for a long time. There's a lot of people swimming naked based on that high tide. And now the tide's gone the other way, and suddenly I'm not swimming against the tide, I'm swimming with the tide. So therefore, I'm in the same place, understanding what I do. I've gotten to be a better swimmer, and I understand the dynamics of the business, and suddenly things have changed because that's the external environment. It's not that I'm doing something different, it's just that there's a rotation. So what we see from our bottom-up stock research, and that's what we talk about, grassroots macroeconomics, and that is by seeing a company, seeing an industry, seeing its impact on a portion of the economy, you really do get understanding as to elements and changes that clearly are happening that therefore have already manifested in many ways, but you can also see those dynamics continue to kind of play out. So, two ideas we think are clearly important for the next decade. One of them is globalization 2.0, right? And everybody knows this, it's not just China, right? So therefore, where things are done and how things are manufactured is changing. And that's been underway, and it continues to move, and it will accelerate. The second one is climate change. We've been energy investors, fossil fuels, since like day one. So therefore, we see that, and we see the world, and we see the concerns about climate. We understand that, and that's having huge macroeconomic impacts. So these things we think have huge impacts for the next, clearly, decade that will have real impact on who's the winners, who's the losers, which may be very different than the winners and the losers looking back. And after all, past performance is not a predictor of future results, right? We all say that, but we don't believe it. The other one is I'd suggest that you listen to this guy, Russell Napier. He's a macroeconomist. The reason I suggest that is he's a macroeconomist, and he has a view, and his view ties into mine. And I'm doing it from a bottom-up, company-specific, industry-specific, and we have a verification of each other. So it's either confirmation bias or there's really validity to what I'm thinking. So the biggest thing that happened to the world economy in the last 40 years is China, right? The ascendancy of the economy in China has had huge impacts on industries, it's had huge impacts on the consumers, it had huge impacts on everything. And of course, what we think is that China 40 years ago and China today are two different places. You know, it is a mature economy today, and it was a nascent economy back then. And so that's what we also think, right? We suggest the idea, once again, I said before, the Fed's ineffective. It didn't stimulate the economy with its policy. The Fed didn't stop inflation from happening. That wasn't Volcker. And so therefore, there's all this misdirection happening today. I think what cured inflation was Ross Perot, when he ran for president in '92, one of his big things was he talked about Mexico, NAFTA, the giant sucking sound. But the fact of the matter is, we know the last 40 years there's been a giant sucking sound, and it hasn't been Mexico, it's been China, right? China has sucked jobs out of the rest of the world. It's sucked industries, it's sucked all these things. It also sucked inflation out of the world. So many things today are made in China. All of us know industries, we'll go visit Nebraska Furniture Mart, the furniture business, like disappeared in North America, and it all moved to China. And of course, now it's not in China anymore. It's moving to Vietnam, Indonesia, and Bangladesh, because that's an evolutionary process and it continues to evolve, and who's in a position to be able to be competitive in industries changes. So China, we think, is a very different place than what it was in the past. And instead of sucking inflation out of the world, costs in China are going up. So if nothing else, it may be the low-cost place for a lot of these things anyway, but costs are going up, and it's not taking costs out of the system. And so that anti-inflationary thing we think is very significant in terms of what's inflation rate, what's interest rates, what's the cap rates on everything, how do you value everything. And so, of course, we all know the population in China's rolled over. You know, there's plenty of other issues. China, in 20 and 21, right, since we follow energy, right, in 20 and 21, energy consumption around the world imploded, right? We all went into our houses, we all shut down. We didn't drive cars, we didn't fly, we didn't do all these things. So energy consumption was down dramatically. Not in China. In China in 20 and 21, oil, gas, coal, electricity, demand, consumption grew both of those years. What happened in 21, of course, was there were power shortages in China. China is short energy when its economy is fully operating. Of course, fortunately, right, the property business imploded in China, which has had a huge negative effect on the economy. And then COVID lockdowns really started to have impact on the economy. So China really is in a recession and has been for a while. And you see that because in 2022, emissions in China were down. So there's no better indicator of industrial activity than emissions, especially in a place that burns more coal, because they didn't want to, they could sell the gas and make money from Europe to do that, and therefore burnt more coal. So therefore, if you're burning more coal and you have a reduction in emissions, you clearly significantly reduced. And if you look back, energy prices in Europe, natural gas and coal prices, had started to spike in the middle of 21. So 6, 7, 8 months before Russia invaded the Ukraine. So it's not, that's fuel on the fire, but the demand for energy and the inability to meet fully that demand was already there in China and was already there in Europe, and prices had already moved higher. You know, this just shows the demographic, right? The hurdle that China has. Wage rates are up dramatically. Mexico's are much cheaper. So therefore, the idea that it's part of the evolution of way you make things evolves back to North America makes all the sense in the world. Somehow you're going to do something with that population in Mexico. And of course, the rest of Asia, whether it's India, Southeast Asia, you've already had seen businesses migrating. that will gain a lot of momentum. There's a lot of reasons to do that. This will all mean a lot of infrastructure build out. And therefore, that will mean materials will be in high demand that already are fully used today. So that's what we say. So we believe in the revenge of the old economy. These businesses have been underinvested in, have had very difficult times. There's been huge consolidation, and that's what happens, right? Schumpeter's process, you talk about this capital cycle that happens. When industries go through difficult times, what do? They shrink, they consolidate, so they cut back capacity, so therefore they moderated back capacity to meet the demand that is today, and there are many fewer players, so the industry structures in many are different. That's why I say in certain cases it's the metamorphosis of the old economy, because these businesses, some of them, are different. There are things like, there's only 3 guys left, there's an oligopoly in a business, and to build one of those plants is extremely difficult. I'd suggest there are barriers to entries in these businesses. I'd suggest, therefore, that means high returns on capital. That means there's an industry of only 3 people, it's disciplined. There's sustainability to that free cash flow. So that's a very different environment, and that's what we believe, that our bottom-up stock research identifies companies that have better businesses, so Buffett better businesses, and yet they have Ben Grant cigar butt prices. They trade at 5 times earnings. They've been 2-3 years generating huge amounts of money. Some of them have net cash on the balance sheet. What are they doing with the continual cash flow? They're buying back stock. So the per share value is continuing to increase even as things moderate. So that's a very different environment that we see from these industrial businesses, especially North American-based businesses, that has existed before. So Dornbush is an economics professor out of MIT, said in economics, things take longer to happen than you think they will, and then they happen faster than you think they could. So our add-on to that is, and the longer it takes, when it happens, the bigger the response is and the quicker it happens. And that's what we think is already starting to unfold, and you see that today. So I'm an energy investor for over 50 years, right? My general observation is the world's energy demands continue to grow. The build out of the supply of that has been constrained. We all know that's true of fossil fuels, right? No one's building a new coal mine. There's limited amount of money spent even on new oil and gas development. There's plenty of reasons why to do that because it does create CO2. The fact of the matter is the build out of renewables isn't fast enough, can't happen fast enough. And of course, in something like power generation where you have the potential to grow that out, right? You start with the base of only 5% of the power generation and you double it to 10%. Well, that's great. But what you did on the 80% that was fossil fuels was you pared back. You didn't reinvest. You shut capacity. So you're reducing the bulk of electric generation capacity. And you saw that clearly Europe has been suffering through the fact that they shut those nuclear power plants, that they shut those coal plants, which they're, of course, ramping back up. So that process means there's an underinvestment clearly in the fossil fuel side, in power generation, and in renewables. So there's more capital that needs to be spent on all those things. So therefore, that huge capital cycle is going to have a demand on materials. Materials that today are fully consumed, any availability supply, you're going to need new capacity, and you're going to need new reserves. Where they're going to come from, what's it going to cost, how is that not inflationary? Of course, in the process, CO2 has been a real problem because, you know, and it was 2006, China matched the United States in terms of its CO2 output. Right, and it's lapped us, and it's today substantially more than twice what we do. And what are they doing in their energy response? She said before the Congress, he said, China will build out renewables as fast as we can, and it is. But it can't build it fast enough to meet their energy demand. So therefore, he says, in the meantime, we will use the providence we have. The providence we have is coal. Right, and last year, they went from burning 4 billion tons, half the world's coal, to 4.4 billion tons. They ramped up their own production. What are they doing now? They're increasing the importation of coal into China. So China will do what it will do, and that is it will burn more fossil fuels while it builds out as fast as it can. And that, I think they have a policy, on a China-only policy, China-first policy, that makes sense, but the rest of the world isn't. We're still constraining much of what we do because we don't want to do that. We don't want to have an impact on the environment. And so that's delayed a response that's created, we think, a really interesting environment. So we think that it is. Energy demands, you know, poised to grow for years as you rotate and move businesses out of China, or businesses grow growth comes in other places, not in China. So China's not going to implode. China's economy will do fine. It's the maturation of China, just like 40 years ago when the United States lost all these businesses, the economy still grow. China will still grow. The fact of the matter is, India, Southeast Asia, many other places are going to have significant growth. That's going to cause that's a lot of capital requirements to do. All those places, of course, when they start to have economic development, the energy consumption goes up dramatically. That's what happens in an economy when it starts to develop. So the potential interplay and difficulty in that process, we think, is clear. And as I say, and the cost of renewables, for 40 years, renewables have come down in cost. And the fact of the matter is, a year or two ago, that stopped happening. The cost of renewables has dramatically increased. And the trends clearly say that's going to happen more. So the one we know the best is we know offshore wind. Right? So in offshore wind, Subsea 7 is one of our investments, and they do development of offshore oil and gas fields, but they also do offshore wind. So in that process, the cost of all of that's going up dramatically. And how do you build offshore wind? You have a huge amount of cement that you put on the bottom of the ocean. You have a huge piece of steel that sticks out of it. You have Gamsia or whoever makes the turbines with all kinds of materials in it. They're all losing money dramatically because the price and the cost of all the materials is dramatically higher than it has been because there's shortages of those materials, and that's driving up the cost. And of course, you got to have a whole bunch of $400 million ships to put the turbines on top of the towers. There's a huge capital outlay with a huge call on materials that's required to do all those things, which will constrain the build-out of renewables, which is clearly critical and needed. You just can't do it fast enough. And even in this process, oil, the slide on the right shows that oil at one point was 50% of the world's energy consumption, and it's now only 30% of the world's energy consumption. But it's okay, over that period of time, it's gone from 30 million barrels to 100 million barrels. So this year, right, will be a new peak in it. So therefore, the gross amount of oil and gas that's going to be needed is higher than where you are today. It's been significant underinvestment. Many years ago, Simmons wrote this book, Twilight in the Desert. I don't think the world understands, and having been an investor in energy, oil, for 50 years, I don't think the world understands where we are today. And where we are today is, his book, of course, was the idea that the Saudis' ability to grow production was limited. And of course, it's disproven, it didn't happen, it went away. The fact of the matter is, today, look again, maybe it's true. The Saudis are saying that themselves. Of course, nobody believes what the Saudis say. They're talking up their own book. They say, yeah, you're sure. Okay, but that's the talk. What's the walk? The walk is, last year, Aramco ramped up spending 60%. You know that. It's a public company. That's all public data. You don't need to guess that. You don't need to rely on some other source. They ramped up spending 60%. They say we will hold at that elevated level for the next 6 years. At the end of that period of time, our expectations is we'll be able to produce 13 million barrels a day instead of 12 million barrels a day. That sounds to me like a pretty mature basin that has been, and one of the things is the offshore rig count's going from 60 to 100 wells next year. There's a dramatic ramp up. And so they're not drilling onshore, they've run out of that. They've got to go offshore. So therefore, their search for oil and new production really indicates that there's limits to their capability. So clearly they're looking to do things with renewables because they see there really is at least at $80 oil. If oil's $130, then maybe things are different. But hopefully that doesn't happen. But at 30, there's maybe more oil. But at today's prices, there's a limited amount of oil. As a result, natural gas is clearly the fossil fuel that really is the bridge fuel. There is availability. The problem with fossil fuel, and you see that, right? Because last year Europe capitulated and said, gee, we don't see any way out of this. We somehow have to figure out how we could say, yeah, natural gas is a temporarily green fuel. So they changed their policies, and that's Europe, and that's a hate for a concern about CO2, a proper concern about CO2. It's still admitting that. So that's why I call it a dirty little secret. The fact of the matter is, with natural gas, it's problematic. With oil, you find it, you can get it to where you want it. With natural gas, once you find it, to get it to where you want it, you got to build out 3 pieces of infrastructure. You got to refrigerate it, you got to transport it, you got to regasify it. And each one of those has to be built either simultaneously or in some process. So that will delay the development of natural gas. So industrial businesses in North America is where we started, where a lot of our investments are, where we think there's a lot of opportunities. We talked about those industries have consolidated down dramatically, many fewer players, rational competitors, totally different environment. The other thing is North America, if it's an industrial business, you're competitively advantaged because you have lower energy prices here, and you will for at least the next 10 years. Right? The inability to move natural gas out of North America means we have an oversupply. So the chart here demonstrates the movement between gas prices in the United States, North America, and gas prices in the rest of the world. So whether you're in Asia or whether you're in Europe, they tie together pretty closely because LNG, it's kind of interchangeable. So the world has this huge separation though. So energy costs in North America are competitively advantaged. In many industries, US companies are competitively advantaged against China companies without a doubt. China is a high-cost place that imports its energy, imports oil and raw materials today because they make so much of everything that they have to import the iron ore and the steel and the metallurgical coal because they use all the stuff they have. They need incremental supplies. So they're tied into the world market, and they're the ones who really set prices, of course. The Inflation Reduction Act, it's another accelerant onto development, capital spend, requirements in North America, but we don't think it's really, that's the icing on the cake. The cake is the fact that it's energy, whether Yara is going to build a fertilizer plant in Corpus Christi is not predicated on the Inflation Reduction Act. It's predicated on the fact that he can use natural gas to make fertilizers at a fraction of the price of what he can in his European plant, so he's going to make the plant here. So therefore, business will continue to migrate because there are competitive advantages. So not only do you have lower costs, of course, you're in market. You don't need to transport it, you're already here. So and of course, the Inflation Reduction Act, we think is a total misnomer. It's a Inflation Accelerant Act. That's what it really will be. Here's an industry we think is interesting, the fertilizer industry based in North America. Stocks trade for single-digit PE multiples. They're minting money like crazy. They're still disciplined in the process. In addition, ammonia is the intermediate product that you make to make fertilizer. Ammonia's usage as part of the new economy and new climate issues is going to be tremendous. It's going to grow. So there's a huge growth opportunity for that intermediate product they make, ammonia. And including the ability to move hydrogen with the use of ammonia. So it ties into a lot of where energy is moving that makes for new end market demands, and the stocks are extremely cheap at valuations that really are disconnected from a 3.5% treasury. Chlor-alkali business is a metamorphosis of an old industry. You make caustic soda, you make chlorine. There are 3 guys in North America, Oxy, Westlake Chemical, and Olin, who make 70, 80% of what's made. Olin has over 40% market share. Olin 3 years ago went to a new policy and said, we only produce what the end market will need. We constrain production otherwise. They meet demands based on production. In that process, they control pricing, they control profitability. Look at the Olin information. They talk about the substantial reduction in volatility in their business. At the low point in the cycle, they're generating $1 billion. The stock has a $7 billion valuation today. So it's got a 12%, 13% free cash flow yield. And what are they doing to money? They're buying back stocks, so therefore they're increasing the per share value. And that business is one that, and North American producers of chlor-alkali are the lowest cost producers because electricity prices and gas prices in North America are cheaper than they are in the rest of the developed world. It has a huge competitive cost advantage. And we're an exporter of those things. So Canadian energy, I'm on the board of a couple of Canadian energy companies. The stocks trade for single-digit PE multiples, free cash flow. They sustain production, grow production some, and generate all this extra money. So the valuation is just wrong. But nobody wants to own them because it's an energy company. So the next thing I want to talk about was my specific stock pick. And my specific stock pick is an industrial real estate business. So it's an industrial real estate business where the supply has substantially dwindled over the last number of years. The demand has substantially increased over the last number of years to the point where occupancy rates are now 90% and higher in certain places. Therefore, the rental rates have dramatically increased. The free cash flows are dramatically increasing. Yet, the prices are far below what would be required for new building. So therefore, you don't have new supply coming on, potentially upset that apple cart. So it's got all these things lined up. Okay, so I misled you. So it's an industrial real estate business that happens to float on the water that is in the logistics business of moving equipment. So the offshore energy business is one that is easy to understand, even if you're not an energy investor, and at valuations that are extremely discounted today. And specifically, offshore, most of those are the public drillers, but the specific one I'm going to talk about is Tidewater. Now, Tidewater, I have my shirt on here with my Tidewater band on it, right? I have Quentin Neen, the CEO of Tidewater, here at the meeting. I'm a director of the company, and I'm a 7.5%, 8% shareholder in the company. So don't believe a word I said. I'm talking up my own book, and so therefore ignore what I have to say from now on. So that's what it is. That the supply of boats has significantly dwindled after almost a decade. So there's no new construction. You've reduced the fleet size. Any piece of equipment that's available has been refurbished and brought back into service in the last year or two, and demand is such that it's 90% occupancy, which is getting close to full utilization. The rates have dramatically increased. The cash flows are dramatically increasing. The demand for equipment is clear and demonstrable, given commitments and that the major oil companies clearly have already committed to and will happen, which are economic. So therefore, the identifiable trend of what's going to happen over the next number of years in the business. Therefore, that means continued rates. So today, we think this is exactly it, right? This is $1 you can buy for 40 cents. So it's pretty easy to do the calculation to come up with that. And that's true of the drillers also. So here's the history. Came out of bankruptcy 2017. Debt-free balance sheet. In a difficult time, you need to have a debt-free balance sheet because cash flows still are troubled. 2019, it merges with Gulfmark. Gulfmark, same thing, went through bankruptcy, comes out with no net debt. So therefore, and you consolidated the businesses. You took out dramatic amount of cost overlay between the two businesses, therefore make them viable even in a difficult point in the cycle. And this is what we look for. We invest in cyclical businesses at low point in the cycle that clearly position themselves well and are advantaged by their balance sheet and the nature of the business. In addition to that merger, we got another asset, and that is we got Quentin as the CEO, who's been extremely valuable in systems and setup and enabling the business to continue being opportunistic, because you also want to be opportunistic when you're in these cyclical businesses at lows, because you could buy assets for far below what they're worth. That is the cash flows they'll generate and what it would cost to replace them. In 2022, the company acquired Swire Pacific for $200 million, their fleet of 50 vessels. That was a Hong Kong conglomerate who 15 years ago got crazy and had too much money and made a mistake of getting into a business they shouldn't have been in. They capitulated and were looking to sell it for 4 or 5 years. Eventually, at the bottom, they sold out right when there was an inflection point. So for $200 million, the 50 boats that Tidewater bought probably were worth replacement cost of $1.5 billion, maybe more than that. And what it also did was there was, again, integration, significant costs you take out of it. So therefore, you're advantaged once again. What you also did was in certain markets, there was both people were there, so therefore you further consolidated those markets, and that enabled you to accelerate the pricing movements that's happened in those markets. And it also puts you in certain markets that you weren't before, so potentially plants to seize to do other things in the future. More recently, in March, the company announced the acquisition of 37 vessels from Solstad, their PSV fleet, so that's one subsegment of the offshore boat business. And that is a business that one of the advantages is Tidewater will now have 30% market share in Norway, an area that has committed capital development and spending over the next number of years, which means there'll be strong utilization and demand. And that's what it is. If you model out the commitments that people have, there's clearly an argument that you need 20 to 30% more vessels than exist in the world today. And in spite of the fact, though, pricing still hasn't gotten anywhere near what you need for replacement cost, and there's no interest in doing that. So therefore, there's potentially a really interesting time of high cash flow generation. Here's some information on what the fleet looks like. This is probably more detailed. It'll bore any of you because it's all about boats and things like that are esoteric. The fleet, it's young, one of the youngest fleets, and so therefore clearly that's valuable. What's the life of the asset? Utilization's continuing to improve. I do want to concentrate. So here's the dollar for 40 cents, right? So the market cap today on a company is about $2.2 billion, right? The estimated new build cost is $5.5 billion. My calculations, that means it's a 40-cent dollar that you can buy. That's particularly relevant because the demand is high and therefore rates are improving. And if you can look at, you could pretty easily model what cash flows look at the next 3, 4 years, 5 years, and those numbers exceed the market caps of these companies. So the cash flow is there. The fact that the replacement cost is also dramatically higher. But not only, when we invest in these cyclical businesses, what we look for is, we're not looking to buy the old buy a dollar for 50 cents, and I guess when it gets to 75, you sell it and you make a little bit of money. We're not looking to do that. We're looking to buy a dollar for much less than that. So our entry point into Tidewater was earlier at much lower prices, and we think we bought a dollar for 20 cents. And we think today you can buy the dollar for 40 cents. But we also want that dollar to grow to $2 and $4 because it's a growth story. We are looking for growth. We are looking to buy businesses in difficult times at values that are discounted from what it would cost to replace that business, that have a runway of opportunity for significant growth. So we're buying growth companies, and we're buying them at discounted prices, right? And here you see a transaction. So we're buying the Solstad fleet for $600 million. What's that fleet worth, new build? $1.7 billion. That fleet is one of the most technologically advanced and best fleets there is out there. We're buying that asset for a fraction of what those assets are worth. And that means that dollar is now worth $1.20. If you go through the calculations on the numbers and you say what the value of it is, what the debt adjusted number is per share, the per share value goes up 25% in this transaction. And it did the same thing when it did Swire. And so therefore, there is not only you're buying $1 for a substantial discount, you're buying a growing dollar. And so that's what makes it a real home run. In addition, the advantage of Tidewater versus the drillers is the drilling industry has recapitalized, restructured, consolidated. The boat business is in a different place. Many fleets are still owned by people who don't really own the fleet. They own the option on the fleet because the bank owns the fleet. And the banks haven't been able to collect their money in a long time, and the banks still therefore control these fleets. So who knows if anything happens? Of course, that's what's provided the opportunity for the Solstat transaction, but there's a fertile industry of opportunities that potentially might provide opportunities for further growth in growing that $1.25 further beyond that. In addition, the other thing I'll point out is, if you look over the last 2 years, there's been consistent and substantial insider buying by one of the insiders. So you got insider buying too, confirming someone's belief anyway, the values are worth significantly higher. I'm not going to go through the rest of this. This is a bunch on why offshore makes sense and why the business really has an identifiable, demonstrable growth pattern, increasing demand, therefore increasing all these things happening. And this is not related to where the price of oil is today. The majors are making commitments here who understand what oil looks like 3 years from now, 4 years from now. And the fact of the matter is, the world's needs for energy exceed what is currently available, and it continues to deplete. You're always depleting. You always need to spend money just to keep it flat. So there's a dramatic need for new capital spending. So in summation, I went too far. Oh, you got to hit the back button, not hit the forward button again. I went too far. Anyway.
I'm very experienced to help you now.
Okay. It's one of the next to last ones, which is just before all the disclaimer kind of stuff. Okay.
Let me know.
No, yeah, keep going. Go. Oh, that's it. Back. Sorry. Yeah. Okay, here you go. Yep. So that's what it is. We think the 40-year bond market juggernaut is over, and we do think inflation is something that will be persistent. More persistent than clearly the market assumes and hopes for today. And all of those things I talked about, reshoring, energy, renewables, huge capital commands of those things, huge resource requirements, all of resources that today there is no excess supply. And to bring on new resources takes time, capital, and all of that, as everything does today, takes more time and more capital than it did before. So therefore, the cost of which continues to move up. The free money policy, the Fed, we think it really is gone. That's why we talked about financial brigadoon, right? Brigadoon is a play. It's two guys wander in Scotland. They come into a little town. They love the town. It's beautiful. It's idyllic. They come back the next day. It's not there because brigadoon shows up one day a year, every 100 years. Financial brigadoon's gone. It's not coming back. Well, much of capital is still invested on the idea we're going to get back to brigadoon. We're going to go back to that age of unicorns, and that really has persistency. Maybe it does. If it doesn't, there's a lot of capital that's misallocated. We think the Schwab situation, the banking situation, is just one of many things where people did things that, based on how long interest rates were low, did things that made sense or were aggressive, that suddenly there's a lot of people swimming naked, and it ain't just a couple of banks, right? Price discovery is reasserting, stock picking, it's all about picking the right companies that are positioned to outperform, and you have to do that. And very few people left, right? We have 15 people at our firm, 10 people who get paid to do it, and the other 5 get paid to do other things, but just want to pick stocks because that's the culture of the place. And I want to pick stocks that win, that go up. I'm smart then. So there are 15 people. That's an asset that's hard for any firm to replicate, including, and that's the minimum probably there's a couple guys with shorter tenures, but most of them have 10 years, 20 years, 30 years of experience. So we've been investing in these companies, understand these industries, understand bottom-up stock research, and our competitors largely have gone away, or they're much smaller, or they've retired and they've gone like Ben Graham did to the south of France, the classics, because that's a lot more fun than picking stock is and being wrong. Active management, I just can't see how it doesn't outperform. And even if you're buying growth companies, right? If you looked at the Nifty 50, right? Half of those you actually ended up being great businesses that over time you did eventually make money in, and half of them went away, right? Polaroids and the Burrows of the world went away. So you got to pick the right ones because not all of them are going to do well. Some are going to do well. Some. Stock picking, it's all about stock picking. So thank you very much.
How about if we have time for one question for Bob Robotti, and you're going to stay during lunch, so he'll be available the next hour. And then how about one question for the CEO of Tidewater, Quinton? I'll give him a microphone if you have questions for either one.
Yep.
Hi, my name is Johannes from Germany. I'd love to understand, macro analysis and value investing, they're potentially quite different. So I wonder if your macro analysis of inflation, energy, and so on, if that's pivotal to the stocks you pick, or is it a free bonus if it happens?
That's right. The supply-demand fundamentals of the boats that Tidewater owns are unaffected by the fact that there's inflation or not. And the fact that there's inflation, and there has been for the last year or two, it's okay. When demand is that strong, you have pricing capacity, you pass that on to your customer. That's not your problem, that's his problem. So if supply-demand fundamentals in your business, they enable you to then, that's another guy's, and my margins are safe. So that the investments we have are not predicated on, and it could well be. I'm talking about only, my view on the world is an extremely informed bottom-up view on companies and industries. And I have high conviction that those dynamics are underway and sustainable. That's all I'm doing. I'm not predicting so much really the future there. And that will have an inflationary impact. But the fact of the matter is, there's a whole part of the world that I don't spend time looking at. And those things may have deflationary impact. So in aggregate, you may not get an inflation, nearly as much inflation as one might be. So, but our companies are really not predicated, our investments are not predicated on, it has to be an inflationary environment.
Question for the CEO?
Hi, I'm Flavio from Guatemala. My question is the Warren Buffett question. If you have one silver bullet, which of your competitors would you make disappear?
Well, that's it's a very leading question. Do I not have it right? Thank you very much. So, well, let me tell you what I look for, okay, and then I'll let you do the math, all right, if you will. So in each of the situations where we're acquiring a company, I look for a reason for the seller to be motivated to sell, right? Because in the situation with Solstad, we were going through the midst of the pandemic. They had invested largely in airplanes and in real estate and hotels. All of those were crashing at a time when the shipping industry had long been in recession. So when our paths crossed, they were desperate to get out of that particular investment, right?
That's Cathay Pacific you're talking about.
Yes, Cathay Pacific is the airline, right? And so as a result, it was just being opportunistic, but then hitting it at the right time, right? On the Solstad acquisition, something similar. One of the benefits of the U.S. capital markets that's underappreciated is the Chapter 11 restructuring process for companies that go through distress, right? You're able to clean yourself up and then pursue, again, growth and other efficiencies in your particular markets. In many international markets, that's not available or nothing similar is available. So this particular company, Solstad, has been languishing for the past 7 years with more debt than it actually had asset values, right? Because it levered up substantially to buy boats right before the cycle turned over. So they're getting to a point now with their banks that they have to restructure. And by me coming in and offering them a cash solution for 20% of their fleet, they are able to catalyze that restructuring and make it to another day. So the next thing that I look for are other companies that are in somewhat of a similar situation. Both of those are different, but they motivate the seller. And there's other opportunities around the world. One of the things I look for now are companies who have been with a capital provider that is not a natural capital provider, right? A distressed debt firm or a private equity firm for too long, for somebody that's been in it for 7 to 10 years. And we have that because this industry has been going through this lull. These are long-lived assets, and it takes a long time to correct. So now that we're correcting, I'm looking for people that want to get out. And there's a lot of people that are just desperate to get out and redeploy that money into something else. So I look for people that are motivated sellers generally, but then I also want to make sure we have the right vessels as well.
Well, join me in thanking Bob Robotti and Quentin, who's going to stay on.
Thanks so much, Bob.
Thank you. Thanks for staying on. So lunch is available just right outside the doors, and we'll be back in a little less than an hour, 55 minutes. That was awesome.